A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
You know, Corn, this whole show runs on GPU compute, and we wouldn't be here without Modal.
Seriously. And that's what powers all our text-to-speech. Everything you're hearing right now.
They're an AI infrastructure platform. Developers use them to run GPU workloads in the cloud with zero infrastructure headaches.
If you're building anything with AI, check them out. Modal.com. You ever look at a pile of money and think, I wonder how many different ways there are to legally describe how much of this is actually mine? No? Just me? Well, today's prompt from Daniel is about the invisible architecture of the global economy, specifically the great divide between GAAP and IFRS. It is the battle of the bean counters, Herman, and I have a feeling you have some very strong opinions on which side has the better spreadsheets.
I have been waiting for this one, Corn. It is the ultimate how the sausage gets made topic for the entire global financial system. And before we dive into the ledger, a quick note that today's episode is powered by Google Gemini 3 Flash. I am Herman Poppleberry, and honestly, the tension between the American way of accounting and the international way is one of those things that sounds dry until you realize it determines where trillions of dollars flow.
Trillions. Right. No pressure. So, for the uninitiated, we're talking about generally accepted accounting principles, which is the American standard, and the international financial reporting standards, which is what pretty much everyone else uses. Why are we the weird kids on the playground again? Why does the US insist on its own special set of rules while the rest of the world is seemingly singing from the same sheet music?
It is a classic case of path dependency mixed with a very specific legal philosophy. To understand why the US sticks to GAAP, you have to look at the rules versus principles debate. GAAP is famously rules-based. It is a massive, incredibly detailed set of instructions. If X happens, you must do Y. It is thousands of pages of specific guidance for almost every conceivable transaction. IFRS, on the other hand, is principles-based. It gives you a framework and says, use your professional judgment to ensure this reflects the economic reality of the business.
So GAAP is like a Lego instruction manual where every single brick is numbered, and IFRS is more like a picture of the finished castle and a pat on the back? Good luck, buddy. Make it look like this.
That is actually a pretty decent way to look at it. The US preference for rules comes down to our litigation environment and our regulatory history. After the 1929 market crash, the US decided that ambiguity was the enemy of investor confidence. The Securities and Exchange Commission, or the SEC, wanted a system where auditors could point to a specific line in a book and say, the company followed the rule. It protects the auditors from being sued, and it theoretically prevents companies from getting too creative with their interpretations.
Theoretically. Because we all know that when you give people a very specific set of rules, they definitely do not spend all their time looking for the one weird loophole that lets them hide $1 billion in a Cayman Islands subsidiary.
Exactly the opposite happens, right? The more specific the rules, the more people look for the bright line tests. If the rule says a lease is a capital lease, if it covers 75% of the asset's life, companies will write contracts for 74.9%. IFRS tries to avoid that by saying, look, if you effectively control the asset, it is a lease, regardless of the decimal point. But the US is wary of that flexibility. We worry that professional judgment in a principles-based system just becomes a cover for whatever makes the earnings look better this quarter.
I can see the American skepticism there. We are a litigious bunch. If an auditor has to stand up in court and say, I found like this was the best representation, a lawyer is going to tear them apart. But if they can say, I followed Rule 842, subsection B, they have a shield. But man, the cost of maintaining that shield must be astronomical. Does having two systems actually hurt the global economy? Or is it just a headache for multinational corporations?
It is a massive headache, and yes, it carries a real cost. If you are a company like Shopify or a giant like Apple, you are dealing with these differences constantly. Think about inventory. Under GAAP, you have a method called LIFO, last in, first out. It assumes the last items you put in your warehouse are the first ones you sell. In an inflationary environment, that lowers your reported profit and, crucially, lowers your tax bill. IFRS completely bans LIFO. They only allow FIFO, first in, first out, or weighted average.
Wait, so if a US company wants to list its shares on an exchange in London or Tokyo, do they have to redo their entire math homework?
For a long time, they did. There was a huge reconciliation requirement. In the mid-2000s, there was this big push for convergence. The Financial Accounting Standards Board in the US and the International Accounting Standards Board started meeting like a divorced couple trying to reconcile for the sake of the kids. They actually managed to align some big things, like how to recognize revenue and how to handle leases. But around 2012, the momentum stalled. The SEC basically signaled that the US wasn't going to fully adopt IFRS anytime soon.
It feels very metric system of us. The whole world is using meters and liters, and we are over here stubbornly clinging to our inches and gallons because, well, because we like them, and changing all the signs would be a pain.
It is even deeper than that. The US capital markets are the largest and most liquid in the world. From the SEC's perspective, why should they cede control of the rules to an international body based in London? If the US adopts IFRS, the FASB loses its primary role. The US government loses its ability to quickly tweak accounting rules in response to a domestic crisis. There is a sovereignty element here that people often overlook.
So it is about power. Shocker. But Daniel also asked about the before times. Before these two giants emerged, what was it like? Was it just the Wild West? Could I just declare that my company's good vibes were worth $1 billion on the balance sheet?
It wasn't quite the Wild West, but it was definitely more like the Mild West. Before the 1930s, accounting was much more of a private matter between a company and its bank, or its few large investors. There were no standardized, generally accepted principles. Companies used what they called conservative methods, but conservative was in the eye of the beholder. You might value your factory at what it cost to build 30 years ago, or you might value it at what you thought you could sell it for tomorrow.
That sounds like a recipe for a bubble. If I can just decide what my assets are worth based on my mood, I'm going to be very optimistic right before I ask for a loan.
And that is exactly what happened in the lead up to 1929. Many companies were writing up their assets during the boom years to show massive profits, which fueled the stock market frenzy. When the crash happened, investors realized those balance sheets were basically works of fiction. That is what led to the Securities Act of 1933 and the 1934 Act. It was the birth of the idea that if you want to sell shares to the public, you have to follow a standard set of rules that everyone can understand.
So we traded creative fiction for dense, rule-bound technical manuals. Probably a good trade for the stability of civilization, but definitely less fun at parties. You mentioned that IFRS is more volatile. Why is that? If it is based on principles, wouldn't it be smoother?
You would think so, but it comes down to how they handle fair value. IFRS is much more open to revaluing assets based on current market prices. Under GAAP, we generally use historical cost. If you bought a piece of land for $1 million in 1970, it stays on your books at $1 million, even if it is worth $50 million now. You only recognize the gain when you sell it. IFRS allows companies to revalue that land to market price periodically.
So if the market goes up, your IFRS balance sheet looks amazing. But if the market dips next year, your profits suddenly look like they fell off a cliff, even if you didn't sell a single thing.
Precisely. That is the volatility source 4 mentioned. During a recovery period, IFRS companies can look like they are growing much faster because they are marking their assets up to the new market reality. GAAP is more conservative in that sense. It keeps things at the lower cost until the cash actually changes hands. It provides a more stable, if slightly less current, picture of the company.
I can see why investors might prefer the GAAP approach during a recession. You don't want your portfolio companies looking like they are bankrupt just because the market had a bad week and their real estate value dipped on paper. But then again, if I am trying to buy a company, I want to know what the stuff is actually worth today, not what some guy paid for it in the Nixon administration.
That is the fundamental tension. Relevance versus reliability. IFRS prioritizes relevance. What is this worth right now? GAAP prioritizes reliability. What can we prove we paid for this? Neither is correct. In an absolute sense, they just serve different priorities. What I find wild is that even with all the talk of convergence, we still have these massive technical gaps, like impairment.
Oh, I love a good impairment talk. Lay it on me.
If a company realizes an asset, say a brand name or a piece of machinery, is worth less than what is on the books, they have to write it down. They take a loss. Under both GAAP and IFRS, you have to do this. But here is the kicker. Under IFRS, if the value of that asset goes back up later, you can reverse the impairment and record a gain. Under US GAAP, once you write it down, it is written down forever, no takebacks.
GAAP sounds like a very stern parent. You said it was worth less, now you have to live with your choices. Why is the US so allergic to reversals?
It goes back to that fear of manipulation. The SEC is terrified that companies will use impairment reversals to manage their earnings. If a company is having a bad quarter, they might suddenly decide, oh, actually, that factory we wrote down last year is worth more now. Look, we made a profit. By banning reversals, GAAP eliminates that specific flavor of accounting shenanigans. It is rigid, but it is predictable.
It feels like there is a deep philosophical divide here about human nature. The IFRS folks seem to trust that accountants are professionals who will do the right thing if given a good framework. The GAAP folks seem to think that if you give an accountant an inch of discretion, they will use it to build a fraudulent empire.
I think that is a very fair assessment of the cultural split, and you see it in how the organizations are funded and structured too. The FASB in the US is overseen by the SEC, which is a government body with teeth. The IASB is a private foundation. It has to convince countries to adopt its standards through diplomacy and proof of quality. It doesn't have a global financial police force to back it up.
So, how does a country like, say, Israel or Ireland decide which one to use? Daniel mentioned he is from Ireland and lives in Israel. What are they doing over there?
Most of the world, including Israel and the European Union, has moved to IFRS. The EU made it mandatory for listed companies back in 2005. They wanted a single capital market, and you can't have that if a German company and a French company are using different math. For them, the benefit of a unified system outweighed the specific domestic preferences. The US is really the last major holdout. Even China has moved its standards to be very closely aligned with IFRS.
We really are the island of GAAP in a sea of IFRS. It makes me wonder about the future of AI in this space. If you have these two massive, slightly different sets of rules, is AI going to make the convergence moot? Because it can just translate between the two instantly.
That is actually where this gets really interesting. We are seeing tools now that can take a set of transactions and generate financial statements in both formats simultaneously. If the translation cost drops to zero, the pressure to have a single global standard might actually decrease. We could live in a multi-standard world where the language you speak depends on which investor you are talking to.
It is like real-time translation for money. I can speak GAAP to my American bank and IFRS to my European investors, and the AI handles the messy details of LIFO versus FIFO and impairment reversals. But wait, if the AI is doing the judgment for the IFRS principles, whose judgment is it? The coders? The training data's?
That is the million-dollar question. Well, the million-dollar if valued under historical cost question. If an AI determines that an asset is impaired based on 1 million data points, is that more or less reliable than a human accountant's professional judgment? Regulators are still sweating over that one. But even without AI, the differences in these standards can change how companies behave. For example, research and development costs.
Oh, this is a big one. This literally determines how much innovation shows up on the balance sheet.
Under US GAAP, almost all R&D costs must be expensed immediately. You spend $1 billion on a new drug, that $1 billion is a loss on this year's income statement. Under IFRS, you can capitalize development costs if you can prove the project is technically feasible and will generate future money. That means the cost becomes an asset on your balance sheet and you spread the expense over many years.
So an IFRS company developing a new technology looks much more profitable on paper during the development phase than a US company doing the exact same thing. That seems like it would give international companies a massive advantage in attracting investors who just look at the bottom line.
It definitely makes them look cleaner in the short term. But the flip side is that if the project fails, the IFRS company has to take a massive sudden impairment hit, whereas the GAAP company has already taken the pain. It is that pay now or pay later dynamic. The US approach is pay now, which is more conservative but can make tech giants look like they are losing money when they are actually building huge future value.
It is funny how much of this comes down to when do we acknowledge the pain? Accounting is just a system for deciding which year gets to be the miserable one.
That is a very cynical and very accurate way of putting it. It is about the timing of recognition. And when you look at how executives are compensated, often based on annual earnings targets, you can see why these rules matter so much. If I can capitalize my development costs, I might hit my bonus target this year. If I have to expense them under GAAP, I might miss it. The rules of accounting literally shape the incentives of the people running the world's biggest companies.
Which brings us back to why the US is so hesitant to change. We have an entire ecosystem built around these specific incentives. Every CPA, every tax lawyer, every software system, every compensation contract in the Fortune 500 is tuned to GAAP. Switching to IFRS isn't just a matter of changing the math. It is a matter of rewiring the entire incentive structure of American capitalism.
And that is why convergence failed. It wasn't because they couldn't agree on the math. It was because the implications of the math were too disruptive to too many powerful interests. Even something as simple as how you value a stock option given to an employee. Source 3 mentions share-based awards is a huge point of contention. The timing and measurement of those expenses can swing a company's reported profit by hundreds of millions of dollars.
It makes me think about what Daniel mentioned regarding the before times. If we went back to a world without these standards, would we actually be worse off? Or would we just have a different kind of transparency? Maybe we would look at cash flow more than earnings.
There is a strong movement for that. Many investors say, I don't care about your GAAP earnings or your IFRS earnings, just show me the cash. Cash is harder to manipulate. You either have the dollar in the bank or you don't. But even cash flow statements have rules. Is a certain payment an operating activity or an investing activity? The bean counters always find a way to add a layer of interpretation.
You can't escape them, Herman. The accountants are the true masters of the universe. They define reality. If they say $1 billion is actually a loss, then for all legal and financial purposes, it is a loss, even if you are sitting on a mountain of gold.
It is a socially constructed reality for sure, but it is one that allows for global trade. Without these standards, you couldn't have a pension fund in California investing in a tech startup in Tel Aviv. They need a common language to assess risk. Even if there are two dialects, GAAP and IFRS, they are close enough that a skilled translator can make sense of them. The Wild West era was only possible because the world was much smaller and less interconnected.
So what is the takeaway for the average person who isn't a CPA? Is it just, don't trust the first number you see on a financial statement?
My takeaway is that profit is a professional opinion, not a physical fact. When you see a company report $1 billion in profit, you have to ask, according to whose rules? If they are a US company, that number means one thing. If they are a German company, it means something else. And if you are comparing the two, you have to be aware of those hidden gears. The LIFO, the R&D capitalization, the impairment reversals that are grinding away under the surface.
It is like comparing a movie's Rotten Tomatoes score to its IMDb score. They are both trying to tell you if the movie is good, but they are using different math to get there. You have to know the platform to understand the rating.
That is a perfect analogy. And just like those scores, accounting standards are constantly evolving. We are seeing new rules now for things like carbon credits and crypto assets. The FASB and IASB are racing to define how you count, a Bitcoin or a carbon offset. Those are the new frontiers where the rules are still being written in real time.
Oh man, accounting for crypto, that sounds like a nightmare. Is a Bitcoin an intangible asset, or inventory, or cash? I bet the GAAP and IFRS people have 5 different answers, and none of them make sense to a normal person.
You nailed it. Currently, under GAAP, it is mostly treated as an indefinite-lived intangible asset, which is a fancy way of saying you have to record it at the price you bought it, and if the price drops, you take a loss. But if the price goes up, you can't record a gain until you sell it. It is the most GAAP solution possible. All the downside, none of the upside until the very end.
Classic. We will acknowledge your pain immediately, but your joy must wait for a formal audit and a signed bill of sale. Well, I feel significantly better about my decision to not become an accountant. It sounds like a lot of stress over where to put a decimal point.
It is the stress of being the gatekeeper. Accountants are the ones who have to tell the CEO, no, you can't report that as a profit. That takes a certain kind of backbone. Whether they are using a rules-based shield or a principles-based framework, they are the ones holding the line against the natural human urge to make things look better than they are.
A toast to the gatekeepers, then, even if they can't agree on whether to use meters or inches. This has been a fascinating look into the plumbing of the world, Herman. I think I finally understand why our financial statements look so different from everyone else's. It is not just stubbornness, it is a whole different philosophy of risk and trust.
It really is. And as the world gets more automated, those philosophies are going to be baked into the code that runs our markets. Understanding the why behind the rules is more important than ever.
Well, I am going to go revalue my collection of vintage sloth memes. I am using the corn principles, which say they are worth at least $1 billion in good vibes.
Good luck getting the SEC to sign off on that one.
They just don't understand the market, Herman. Anyway, that is our deep dive into the world of GAAP and IFRS. Big thanks to Daniel for the prompt. You really know how to make us work for it.
And thanks to our producer, Hilbert Flumingtop, for keeping the gears turning behind the scenes.
Also, a huge shout out to Modal for providing the GPU credits that power this show. We couldn't do these deep dives without that serverless horsepower.
This has been My Weird Prompts. If you are enjoying the show, a quick review on your podcast app helps us reach new listeners and keeps the bean counters happy.
Find us at myweirdprompts.com for the full archive and all the ways to subscribe. Catch you in the next one.
Bye, everyone.
This episode was produced using Google Gemini 3 Flash, text-to-speech by Chatterbox.
Thanks for listening to our show, My Weird Prompts, where our thoughts go from slow takes to facts on cue. We change and follow through. My weird prompts, that's the flows from slow